Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Adam Fayed. Adam's helped clients in over 100 countries manage and protect over $100 million in assets. He's got a no-nonsense approach, which means that he is also the most viewed financial writer on Quora with over 822 million views. He's also a contributor to Forbes and also has appeared on CNBC as well. And in a nutshell, whether it's protecting wealth or looking to maximize the system, so to speak, Adam's perspective should hit home for anyone who wants any form of practical or global financial advice. That being said, we're going to discuss a lot in this podcast episode. It's not to be constituted as investment advice in any way, solely for educational purposes. Adam, disclaimer done. Welcome to the show. How are you?
I'm very good. How are you doing? And thanks for inviting me as well.
I'm really looking forward to this. We were just talking quite a lot off air and looking at different countries and things that we can talk about. But before we get into that, a little bit more about yourself, if you can, a bit more about your background and what it is that you have done to help so many people in different countries.
Sure. So basically, for myself, I had a life-changing trip in 2007 when I went with my closest friend to China and Southeast Asia pre iPhone, well, a few months before the iPhone was released, and pre the whole kind of technological revolution. Because even though technology was becoming a more important thing, traveling in 2007 had more in common with 97 than say 10 years later. So I had that frontier country trip, so to speak, because China was quite a frontier country at that time before the Beijing Olympics. And it really put the traveling bug inside my system. Now, a few years later, that close friend of mine, he went to live and work in China. And the UK economy was struggling quite a lot, as you might have remembered, after the financial crisis. So after leaving university, I thought to myself, well, even though I don't have a lot of experience apart from like part-time experience, minor entrepreneurship, and so on and so forth, trying things and failing and things like that, now would actually be a pretty good time to leave the UK. Because even if I leave the UK and it doesn't really work out, I'm young, I don't have responsibility. So I actually left the UK less than 24 hours after I graduated. I got on the plane less than 24 hours after picking up my university degree. And then subsequently, I got into the financial sector. Even though I learned reasonable Chinese in China, I got a job with a company which is focused on expats and also Chinese people who lived overseas. So it was an expat financial management company in Shanghai, British owned at the time. And then subsequently, I went off and worked with different companies. Now, in 2018, I thought to myself, well, you know what? I'm doing things more and more online myself. Clients move all around the world. So surely it's possible to actually have an online model in my industry. And most people at the time thought it wasn't possible. Maybe doing insurance online, something which is quite transactional, would be possible. But doing things when it comes to investing and so on and so forth, like higher trust services, wouldn't be possible online. Now, I know that sounds incredible to maybe very young viewers, but pre-COVID, a lot of people did still think the higher trust services should be done face to face. But I took the plunge to be fully remote from 2018 onwards, years ago now. But of course, after COVID, the model took off for obvious reasons with the lockdowns. And
Mm.
that's when it really expanded to over 100 countries in the world where we have clients. And we have clients in all the major regions now around the world, not just continents, but all the main regions. And most of our clients are expats and high net wealth individuals. And then subsequently, we've also brought on obviously many people underneath us, like our advisors or brokers or whatever. So we have teams in different parts of the world, and we're trying to also encourage them to go online as well and get the scale online. So yeah, that's little bit about myself and my journey.
Well, there's so much information out there, and I think alluded to in core it's over 822 million views, but I know in total across all these social medias, it's over a billion views, which puts you number one in the world at that. So it's a phenomenal achievement. we were also sort of talking off air about different countries and things that we could talk about today. Because obviously, there's a lot of countries and a lot of people from around the
Mhm.
world are going to be listening. I think the place to start, purely because most of the audience listens from the United States of America. And again, the things that we're going to talk about are just trying to put ideas into people's head that if you're bored or upset or annoyed with the current system in your country, that nothing's impossible, and there are going to be ways where you can expand your horizons or become more tax efficient or whatever it is you want to do. And again, this is the purpose of this conversation. But let's start with the USA because that's where most people listen from. They are, last time I checked in, they're taxed on global income, so that could be difficult if they do want to leave. Uh, so again, from your experience with what you do, if you're an American listener, what could you look to do to move country or become more efficient tax wise?
Well, first of all, it all depends on what you want to do. So I've lived in so many different countries, 7 or 8 different countries during my time overseas, and I've also spent a decent amount of time in 2 or 3 hours. So that's about 10 different countries, and it all depends on what you want. So some people might just want an experience for 1 or 2 years and they want to go overseas. Other people might just want to save on cost of living. So I know, for example, in Mexico, there are some Americans and Canadians for that matter who work for American companies, but they live in Mexico and they're doing it because the cost of living is lower. They're interested in the culture. They might learn the language and so on and so forth. And they don't care about paying the same taxes as back in the US because they're still winning overall. That's one approach, right? But a second approach is if you're going to live and work overseas for a long time, you can consider renouncing your green card and citizenship as well. Now, that's obviously a big step, but more and more Americans are doing that globally. So, for example, the co-founder of Facebook, Edward Swarin, I think he was just an investor rather than
Mm.
obviously as important as Mark Zuckerberg. He gave up his American citizenship. I believe Tina Turner and a few others have as well. But every year there's like about 5, 6, 7,000 Americans who do it, which means over a course of a decade, there's about 65, 70,000 people who do it. However, obviously it's a big step. So a lot of the people who do this, often they weren't born in the US. They acquired US citizenship, but then when they leave the US, they think, is this really worthwhile to have this? So we have had clients who have renounced their citizenship, but most of the people who do it are either non Americans in terms of they weren't born in America. They might be legally speaking Americans in terms of their passport, but they can remember a life before, having the US citizenship. Or they're people who have lived overseas for 20, 30, 35 years. They get fed up of all the reporting and all the requirements from the IRS. And they think, you know what? I've lived in this new country now for whatever, 20, 30 years. I'm fed up now. I'm just going to renounce, or they're very wealthy. Doesn't have to mean they're a billionaire, but they could be much wealthier than the vast majority of people, and they think it's worth it to give up their citizenship. So obviously, it comes with tax ramifications, exit taxes, and so on. But ultimately, those are the two things I would consider. Are you moving for financial reasons or more like lifestyle? And also, how long are you going overseas for? If you're just going for a year or two, you're happy to pocket the cost of living difference to save and invest more, then maybe you don't need to care about taxes. But if you're going to be overseas for decades and you've got a lot of money, or you've got an easy way of getting a second citizenship, I would definitely consider the renunciation, should I say, process because it might sound like it's not very patriotic or whatever, but in reality, most people would consider it. I mean, I know for myself, if the British government brought in citizenship by taxation, I would certainly look at my options in terms of renouncing, right? So at the end of the day, it's a normal thing to do, and a lot of people, I think, fundamentally think this is just not right. If I'm not set in foot in the US even once a year, or literally once a year for a week, why should I pay tax to the US government? So at the end of the day, definitely consider that option, even though it might consider, or you might consider it, should I say, to be quite a radical step.
No, fair enough. I want to apologise if you heard an advert in the background there. YouTube decided to randomly start playing an advert. Apologies if you've heard that on the audio. Going on the UK, yes, I'd agree with you. If they bought something like that in, I would. then certainly also be considering properly removing myself from the system, so to speak. What I take from that, Adam, is really start with the end in mind. So it's maybe thinking about lifestyle design and what it is you're looking to achieve. And then once you've got that why or that idea, then you can almost work backwards and then come up with a plan that might actually work best for you. That's my key takeaway from what you've just said.
Absolutely, because if you've never lived abroad before, you might move abroad and decide you don't like it for whatever reason, or certainly not for the long term. So it wouldn't make sense to make any decisions before you've considered the end and also had a little bit of experience abroad as well.
Well, that's perfectly understandable. The thing as well is that there are always options out there. And going back to your point about the UK government in particular, I'm not going to just start bashing governments for no reason, but we're also in that time where, because of the way that the financial systems are working and number one, who's in charge and what they're looking to achieve and inflation and so forth and currency printing, we're also getting to that stage where governments will look to start taking more drastic actions. That could be
Mhm.
increasing of taxes and so forth. So this is why conversations like this are quite pertinent, where if you can see that that's coming down the road and it might happen because again you just never know who's in charge, then it's important to get this planning now. So if you were in a situation where, let's just say you're in the UK and everything in your life is the UK, you're starting to distrust the government a bit more day by day, then what would your suggestion be? Would it be, would take a holiday for a couple of months, or maybe try and do a bit of traveling, or have a think? If you're in that situation anywhere in the world, what would you say to people?
Well, to begin with, I wouldn't put all your eggs in one basket, regardless of taxation and other factors. So, for example, it is true that in almost every country in the world, governments will try to bring in tax incentives to ensure that you save and invest locally, because they want you to obviously pay into the system and so on. So, even in high tax countries, of course, governments will try to bring in incentives for you not to move your money abroad, even if it's perfectly legal to move your money abroad in most
Mm,
countries. However, it's always good to have a plan B, a backup. Why, if I close down my offshore accounts or move all my money back to the UK, even though it would no longer, in most cases, be tax efficient as a UK resident. Because guess what? If I moved abroad again, or there was a massive problem in the UK, then at the end of the day, you'd be in a bit of trouble, there'd be a lot of hassle and so on. And one thing I would say is, I think in developed countries, a lot of people do make the mistake of thinking that these crises only happen to Arab people's countries, like they only happen in Venezuela or Cuba or Lebanon or
mm,
whatever. But you've got to remember that things change. Like, for example, Lebanon was considered like the Paris or the Dubai of the Middle East in the 1960s, and they've regularly been a basket case since. Also, Cuba and Venezuela. Venezuela used to have a higher per capita income than the UK and almost every country in the world in 1950. I think they were number 3 or 4 in the world. And Germany is an advanced country, but they've had, at least for people living in the east of Germany, they've had 3 inflationary episodes in the last 100 years. The Weimar Republic, then when they unified with West Germany, people in East Germany indirectly faced actually quite a big, uh, inflationary situation. Maybe not
mm,
directly, but the way it was converted to Deutschmark was not particularly fair, let's say. And then when Germany joined the euro, even though it's true that the eurozone has been quite a low inflation zone, on day one, again, the way the conversions were done from Deutschmark to euros, anyone who was on the ground said it wasn't particularly good. So if you had your money in an East German bank and you were born in, say, I don't know, 1910, and you were alive in 2000, 2001, 2002, you would have faced 3 episodes, and that's for a developed country, right?
mm,
So you never know what's going to happen. And even, in our parents' lifetime, the UK's gone to the IMF. Uh, the pound used to be 5 to 1 against the dollar at one stage. When I first started traveling, it was 2 to 1. against the
Mm.
dollar in 2007. That's not a complete collapse of the currency, right? But the point is, never think it's just our people's countries that have these problems. It could be our country one day, it could be our currency one day. So don't put all your eggs in one basket. Don't rely on one system, one government, one investment, one currency. Always spread your risk a bit. So there's nothing wrong with saying, you know what? Yes, I'm a, I don't know, Canadian resident or French resident or whatever right now. And yes, that does mean that if I invest in, I don't know, real estate or stocks or whatever it is abroad, I'm not going to get the full tax benefit of that compared to if I live in a, tax-friendly jurisdiction. But still, you're diversifying your risk. You're also making it more familiar as well to you. So if you start spending a little bit more time abroad, if you start investing a little bit more abroad, then it's more likely you'll feel comfortable to spend more time abroad and maybe move abroad and maybe invest more abroad as well.
Just on offshore banking, 'cause it always seems to be, those two words seem to spark panic in people that are new to this sort of stuff. And it's actually, to my understanding, it's not that difficult. It's quite literally a bank account that's not in your home jurisdiction. I don't know if you've got any other myths that you can dispel on that at all, Adam.
Yeah, so offshore banking typically and offshore in general usually just means it's outside of your home country. um, where you're living. So if you're living in, say, the UK and you're Italian, but you have bank accounts in Italy and say the United States, that's offshore banking, for example. Now, historically, offshore banking has meant like places like Cayman Islands and so on, but it doesn't just mean that. And another myth as well is this idea that offshore is kind of sleazy and it's kind of like all for tax dodging and so on. In reality, often places like the US and UK are actually the biggest tax avoidance centers these days. So, for example, I think Delaware in the US has more offshore companies than the whole of the Cayman Islands combined. Likewise, the City of London is used a lot by non-residents, and there's nothing wrong with that. Why shouldn't non-residents use Delaware or the City of London or whatever? But we've got to actually remember that offshore doesn't mean sleazy at all. And also, these days, things are transparent, right? You do have to put down your tax number if you have an offshore bank account or any bank account. So, for example, that means a national insurance number if you're living in the UK. That means Social Security if you're living in the US, or if you're living in Mexico, there will be the equivalent. Or if you're living in somewhere like, I don't know, Saudi or Oman or somewhere that doesn't have any income tax. Well, Oman will soon, but that's another matter. That's fine, but you've got to prove you're living in that country. You can say, I've got no tax number available, but then you've got to support that you're living in that place. So I'm not saying it's perfect per se, but some people still have this kind of Wolf of Wall Street idea of offshore finance and offshore banking that is like strapping money to your body and it's, sleazy and things like that. In reality, you see the same thing with crypto. I'm not a massive crypto bull or whatever, but one of the most ridiculous things was when people said it's used for money laundering first and foremost. At the end of the day, I'm pretty sure most criminals, obviously I'm no expert on this, but I'm pretty sure most criminals will still prefer to use cash than crypto or offshore centers. Because as soon as you start doing things online and moving money, you leave a trace, right? So at the end of the day, you wouldn't be against cash, right? But cash is used predominantly for money laundering more than any other mechanism, including crypto, including offshore banking. But just because like a small percent of people launder $100 bills doesn't mean the whole situation with cash is sleazy, right?
Mm.
So yeah, those are like some of the myths. Also, it is harder these days to get offshore banking in those traditional jurisdictions like Cayman and so on. But yeah, that's another story. But yeah, essentially, offshore banking and offshore investments is just investing or banking in a place outside of your country of residence. But naturally, people do prefer those tax efficient jurisdictions because let's say you're British and you're living in, say, I don't know, Singapore or Dubai or Oman or somewhere else, which is very tax efficient. You're not going to want like withholding taxes from the US, for example.
Mm.
You're not going to want to invest in any country probably that taxes you directly, because why should you pay tax as a non-resident? So a lot of people do like those jurisdictions like a Luxembourg or a Switzerland, or yes, a Cayman or Bahamas or whatever, because they don't tax you, directly on withholding or capital gains. It all depends on where you're living yourself. So I think the biggest misconception at the moment is that offshore is kind of sleazy. It's all about tax evasion and so on, which is just not the case.
Well, thanks for simplifying that as well, because I say it's important. We're here to try and broaden the horizons for people. So thank you for clarifying that. You mentioned there about crypto, and I was going to ask you, for your opinions on both crypto, gold, silver, and also cash in general. So maybe attack it in that order. What are your opinions on crypto, gold, silver, and cash?
Well, if we look at gold and silver to begin with, if you look very long term, the price of gold hasn't actually moved much at all in real terms. I think since the time of Christ, it's essentially stayed stagnant, adjusted for inflation. So even the gold bulls, people who are bullish about gold, they argued that it's just a wealth preservation tool, one part of a portfolio. Yes, there will be times where it will dramatically outpace inflation in the 70s and 80s and also since 2000. But there will be times when it won't beat inflation. So I'll give you an example. If you would have held gold from 1980 until today, depending on how you measure inflation, you wouldn't have made any money pretty much adjusted for inflation. But if you would have held gold from 1990 until today or 2000 until today, then you would have made money adjusted for inflation. So if you're going to buy gold and silver, you always have to ask yourself, why are you doing it? Um, so if you're doing it just to have an uncorrelated asset in your portfolio, that could be a good reason to hold a certain percentage if you want in gold and silver. Likewise, it's true to say that, believe it or not, gold is much more volatile than you might think. So occasionally it goes very low, like in the early 2000s. And if it goes that low, you could argue, well, there's a good reason to, own it.
Mhm.
Um, but I wouldn't own it if you think very long term it's going to kind of beat the stock market, for example, because ultimately it's not based on innovation. So it's not going to, do 20% per year or 10% per year for the very long term. Whereas if you buy something like, the NASDAQ, it's going to be up and down and so on, but the chance of you making much more money is much higher. I also wouldn't buy gold and silver if you think like the end of time is coming, because, first of all, if things got that bad, you'd be more concerned with, it sounds morbid, but you'd be more concerned with ending your own life or whatever. Or it's ludicrous if you see what I mean. There's a small percent of people who think like you should own gold and silver because there's going to be societal collapse. But if you think about it, people would beat the hell out of you in the street if they saw your pockets bulging with food or gold or whatever, right? So that's
Mm.
obviously not a reason to, buy it. I'm not saying that's a majority of people who buy gold and silver, but there is that element there that people think if there's going to be a collapse, buy gold and silver, and that kind of leads me to something as well. Gold tends to do well during moments where there's quite a bit of worry, but not
Mhm.
enormous worry. So I'll give you an example. During moments like the 2008 financial crisis, gold tends to go down. So before the crisis, gold was at about 1,900 to 1,000. It then went all the way down to 690 or 695 during the worst of the crisis. But then once the crisis was better, gold went up again dramatically in 2010 and 11, and then it fell for quite a few years. Likewise, in COVID, during the worst of the crisis, when people thought, well, this could be really, really, really bad, gold fell. But as soon as it was clear that it wasn't going to be like a Great Depression, gold rose in value again. So moments like now, where, for example, growth is not great, but it's okay, people are still a little bit worried about inflation. They're more worried about war. They're worried about the US dollar a bit. They're worried about Trump or whoever else is in power in some cases. Gold tends to do well during these kind of moments where people are worried, but they don't think like the end of the world is coming. But people shouldn't buy gold if they think things are going to get incredibly bad. If there was like a Great Depression or something like that, I very much doubt the gold would do that well. And ditto silver. Silver's more of an industrial metal. So if growth is actually very bad, you shouldn't expect silver to do really well medium term. So the bottom line with gold and silver as well is it's something to hold to diversify a portfolio. It's not something to hold if you think the world's going to come to an end or even there's going to be a Great Depression. In terms of Bitcoin, that leads me on to Bitcoin. The thing with Bitcoin that I never completely understood is it was pitched to me in 2013, believe it or not, as this kind of libertarian dream that it would be kind of like PayPal, but better. In other words, let's say if somebody was taken off the SWIFT, like you wanted to help, I don't know,
Mhm.
human rights groups in Cuba or North Korea, you could pay them in Bitcoin, but you couldn't pay them using the SWIFT for obvious reasons because they were cut off the SWIFT, even the good guys, right? That's how it was pitched to me. Like people who liked it said, this is not about making money, it's just about a currency, it's about freedom, it's about a libertarian dream. But subsequently, it's become something quite different where people buy it for an investment. They celebrate when there's more regulation because it brings in institutional investors. And that wasn't the original aim of Bitcoin. It wasn't supposed to be the case that if BlackRock became the biggest investor in Bitcoin, the price would go up and some Bitcoin bulls would celebrate the fact that it's gone up because of government regulation and institutional investors. So with Bitcoin, I'm not really sure yet uh, about it because I don't know what the end goal is. Some people now are saying it's like buying software, right? Other people are still saying it's more like a libertarian thing, and I really doubt that. The thing with Bitcoin that I don't completely yet understand, because none of us have experienced a moment like this, is how would Bitcoin react in a really bad crisis? So previously, I've said on this answer, the gold doesn't do well when things go really bad. But gold has existed for thousands of years, right? So it does come back. Like if there was a Great Depression number two, even if gold doesn't do well during the Great Depression, that doesn't mean it's going to do badly for hundreds of years, right? Or tens of years for that matter. It will come back. It's not going to go to zero, right? Whereas with Bitcoin, you question what would happen if things got really bad because during the 2020 crisis, Bitcoin went, I think, to about $3,000 a coin. And that was even with the situation not going incredibly bad. Imagine there would have been a wider panic and a second Great Depression, and the price went down to two or 300 or less per coin. You wonder in that situation what would have happened. And that's one thing I would say about Bitcoin. Unlike, for example, gold or silver or the stock market, it has not proved that it can come back from a really awful crisis because it came in 2009 after the great financial crisis. And it was very small for the first number of years, right, until about 2018. And since then, there's only really been two significant stock market crashes. 2020 was significant, and Bitcoin worse than crash, and then it subsequently did well. And by the way, 2022, Bitcoin also did very poorly during the stock market correction.
Mm.
The stock market went down 20 odd percent. I think Bitcoin was down 50, 60 more percent. So the ironic thing about Bitcoin, or ironic, should I say, is if you look at Bitcoin's performance compared to a leveraged tech fund, like how you can buy the NASDAQ on leverage, it's actually behaved very similar. In other words, when the NASDAQ's doing well, Bitcoin does incredibly well in general. When the NASDAQ and stocks are down in a very significant way, like minus 20%, or people are worried, Bitcoin often has done even worse than stocks. So Bitcoin has proved that it isn't an inflation hedge because it did really poorly in 2022. Uh, it isn't a recession hedge that it proved in 2020, but it has proved it can go up over time and it can be a good speculative investment, but it's still a speculative investment at this stage. I think if Bitcoin survives a really bad period, like say a Great Depression, that would answer a lot of questions that people still have about Bitcoin. Because when you ask people why you're going into Bitcoin, what I find is you can get 10 different answers from 10 different people.
Mm.
Um, And so there's still a lot of question marks about Bitcoin. That's what I would say. And the final comment I would make on that is I would read Nassim Taleb's argument about Bitcoin. So he was the author of The Black Swan, and he's an intellectual. I don't agree with everything he says, but he's obviously an incredibly smart person. He used to be very bullish on Bitcoin, but he wrote a really good paper where he said a few years ago why he thinks there's an argument that Bitcoin's value should be zero. And a lot of people would dismiss that and say, well, it's gone up in value. But Talib's argument is it doesn't matter if Bitcoin's 200,000 today or 200. There are certain reasons why he's very bearish now about Bitcoin, having previously been very optimistic. So before people put a high degree or a high amount of their net worth in Bitcoin, I would definitely read Talib's argument with an open mind and decide what you think about it.
Well, thanks for deep diving into that. Just going back on that correlation between Bitcoin and the Nasdaq, it is uncanny. I will try and find a chart to put in with this post as well if you've not seen the chart before. It is uncanny, that correlation. So I think really it's a case of watch this space with regards to what you've just said, because you're going to have you will have people that say, well, we're off to X amount, a million a coin or whatever. And there's data to say that that could happen, but also,
Hmm.
as you said, if things out there get very bad in the markets, which I would imagine in the next couple of years is likely, then that's going to be the point for Bitcoin. Uh, that being said, what are your opinions on cash? Because if people are sat on the sidelines with cash, obviously, as we've discussed earlier, inflation could erode that purchasing power, or government spending and government inability physically could erode that power for people. But some people will argue that actually having a bit of cash on the sideline could be good for potential opportunities. What are your thoughts, and what would you say to people at the moment?
Yeah, I mean, I think what you just said about Bitcoin is directly related to cash because ultimately an investor can only base their decisions based on the information they have available at the time. There's no doubt that Bitcoin could go to a million or it could go to 100 or 1,000, right? But that
Mm.
doesn't necessarily mean anything today, right? And I think the same with cash. We can only base it on what we know at this time. And what we know is very long term, cash is always a losing asset. We also know that cash is not as risk-free as people think because of currency devaluations and so on. And it doesn't always have to be something dramatic like Venezuela. Let's say someone lived in the UK in 2007 and now they're living overseas and they just kept their money in a UK sterling bank account. Indirectly, they would have lost about 60, 70% because the pound has plummeted. And during the zero interest rate era, they lost a lot of money indirectly to inflation.
Mm.
However, what is true about cash is it means that there are certain ways you can take advantage of the market falling. It's true, you can't time the market. You can't realistically say, I know when a crisis is going to happen. But what we know from traditional portfolio theory is the traditional suggestion was to have, say, 60, 70, 80, 90% in the stock market and the rest in government bonds. And the idea was we're not going to try to time the market per se, but we do know the market's going to fall sometimes. That's the nature of markets. And when markets fall, bonds should hold their value or even go up in price. So we can sell off some of the bonds and buy some of the stocks. That's called rebalancing. So what I do think though is government bonds are looking much riskier than before because of all the debt, all the let's say very unusual policies that are being pursued around the world when it comes to government debts.
Mm.
So that is an argument for saying when it comes to your uncorrelated assets, maybe hold a little bit in cash and a little bit in gold and so on. I can see why that argument now is more pertinent than it was, say, 5 or 6 years ago, because government bonds are looking pretty risky. So, and another factor is I think we have to make a separation here between a business owner and an individual investor. So, if you're an individual investor, basically, if you're not going to invest for at least 5 years, I would keep it in cash or a large portion of it in cash because if you're saving up for like a wedding or going traveling in 2 or 3 years, you probably should just keep it in cash unless it's in a really risky currency. But if you're going to invest for 5 years plus, probably you should just invest it in a diversified portfolio and forget about it. If you're a high risk investor, go for a high risk portfolio. A low risk investor, go for a low risk portfolio, but just invest it. However, if you're a business owner, it's quite different if you're just looking at the public stock markets, because when it comes to private markets, it's a very different situation. The reason why it's very difficult to beat the stock market with publicly available stocks is that all the information is publicly available by definition, right? So at the end of the day, if it's really so obvious that the US stock market is under or overvalued, then everybody else will have the same information. But if you're in private markets, and I'm sure there's business owners listening and watching this, it's a bit different. And also, you don't know when deals are going to come about. So, for example, in my industry, I bought out some financial advisors and wealth managers who want to retire, for example. They're just fed up with being in business. And those have been some of the best deals I've ever done. But obviously, they come with more risk than, say, investing in the S&P 500. So I think business owners should have some money in cash, but you've got to strike a balance, right? Because those deals might never come. It's not always going to be the case that you're going to know, okay, well, next June, there's going to be this really great opportunity, and I'm
Hmm.
going to invest in that opportunity. So I would say cash is okay, but uh, be careful of your allocations. And there's only limited times when it makes sense to hold cash to any significant degree. So what happened last year, you could argue, well, cash was paying at one stage, whatever, 4.5, 5.5% in many major currencies. But that actually doesn't happen very often, at least in recent times where cash has paid 2 or 3% above inflation. Because inflation was relatively low last year compared to 2 or 3 years ago, and cash was paying above inflation. But even now in the Eurozone, you'll get like 2% on cash, and inflation is 2 or 3%. In the UK, inflation is 3 or 4%, I think, and you get about 3 or 4% from the bank. In the US, I think you still get a bit more, but inflation's a little bit higher or marginally higher. So yeah, I would have a balance. It also depends on your age, though, I think as well, because if you're approaching retirement, for example, and you have 5 years worth of savings for your first 5 years of retirement, it might not be financially optimal, but if that can ensure you can sleep at night, then, maybe there's an argument for that on an emotional level. But if you're in your 20s, 30s, 40s, even early 50s, and you're like 80% in cash and 20% in other things, actually you're taking a bigger risk than you think. You're missing out on opportunities, and there's no good reason to do that. Would be my argument. So yeah, I think I'm not saying cash is trash, which is what Ray Dalio said famously, but
Mhm.
certainly cash is usually trash if you hold it for the medium to long term.
So what I take away from what you've mentioned about gold, silver, Bitcoin, and cash there is that there isn't a one solution fits all. It will depend on, again, what your circumstances are. You know, are you a business owner? Are you an individual? Well, how old are you? You know, what
Mm.
jurisdiction are you in at the moment? And what are you looking to try and achieve? So again, it's really a case of going back to the very start, and if you are in a position where you might have exposure to A, B, and C, or you want to, create passive income through X, Y, and Z, or you want plan B and a secondary passport, whatever it might be, actually have a sit down and have a think about what it is you're trying to achieve first would help. And then, as we said before, you can sort of r role reverse it or work backwards is what I'm trying to say. And then you'll then have an idea or strategy that would then work for you.
Absolutely right. And what I would say though is, for the vast majority of people in the vast majority of circumstances, it doesn't make sense if allocations are too high for too long into a lot of these asset classes. Obviously it does depend on people's circumstances, but for the vast majority of people actually out there, mistakes they often make is they think, for example, the stock market is really risky, but actually, very long term, if you do it in the right way, It's a good way of building wealth above inflation. It's just volatile, but it has actually proven it can actually weather so many storms. Like the US stock market, how many depressions and recessions has there been? But the average return of the US stock market has been about 7% above inflation for 100 or 200 years. So they are tried and tested assets. Gold and silver are too, but long term they kind of tread water. They just have the good and bad periods. So I would say for most people out there, they can consider gold and silver and cash and also alternatives. And you could put Bitcoin as one of the many alternative assets. But for most people, it doesn't make sense to have 60% of your portfolio in silver, for example. Um, Keeping the allocations relatively low for most people, makes sense.
We've covered a lot of ground today in this episode. We've looked at the overview, in terms of finances and what potentially is going to happen and what people could do to help themselves. We've looked at certainly the USA and then Plan B and what people could do, and then you've gone in depth there on Bitcoin, gold, silver, and also cash. Again, mixing an overview of everything. Is there anything else that you haven't mentioned yet that you think people should know before we wrap up the conversation?
Yeah, I mean, there's a few things to consider as well. So you know what you said about, say, cash. Some people have cash on the sidelines because they want to wait for assets to actually fall in value, like, say, for
Mm,
example, the stock market. They think, well, I could make a lot of money if I wait until the stock market crashes and then buy it. Which is true, but then you've got to factor in, well, if you were just invested for the long term, would have you have made more money just being invested for the long term? But what you do have to remember is plenty of brokers out there will give you a margin account, which is leverage, a kind of a debt, if you like. So if you've got, for example, 500,000 in an account, you can trade with, often a million, 1.5, 2 million. Obviously, I wouldn't encourage anyone to regularly trade with margin if they're not a financial professional, because by definition, there's a big risk. But by the same token, if you're really convinced that the stock market is going to go down by 50%, or you think there's a decent chance even,
mm,
rationally speaking, you shouldn't be afraid of that if you've got that margin facility. Because if you think about it, if you put in money to the stock market and the stock market crashes, but you're convinced it's going to recover, you're going to recover your principal. But in addition to that, if you were brave when everybody else is scared and you put some margin to work, you're going to make even more money than if you sat on cash. So if you see what I mean, if you've got that margin facility, you shouldn't use it regularly, but if you wanted to just use it when the market crashes, you would make a lot of money if the market then, say, recovered. So I don't think keeping cash is a good idea if the only reason you're keeping it is to wait for assets to recover and then get back to where they were. Because rationally speaking, if that was the case, you should use margin. So, and that kind of leads me to another thing, though. I would say behavior, believe it or not, is the biggest reason people don't make the returns they hope for. Because greed and fear are quite ironic. I mean, human nature is really quite ironic. Most people get greedy when other people get greedy, and most people get fearful when other people get fearful. But it was Warren Buffett who once said, get greedy when others are fearful, and get
mm,
fearful when others are greedy. And ultimately, the ironic thing is, I just mentioned margin. It's incredible how many people want to use margin when the stock markets are going up every day or every week, but very few people want to use margin when the stock market's going down because they think this time is different. This time the market's not going to recover. And even the Bitcoin people, right? They say they're not afraid of volatility, but I think stats show very clearly that when Bitcoin's going crazy, more people use margin and debt to buy it. And then when it's crashing, fewer people use margin. But rationally speaking, you should actually want to use more margin if you really believe in the asset when it's gone down and it's crashed, right? And again, I'm not saying people should use margin. I think it was Charlie Munger who said that leverage alongside the other two L's, liquor and ladies, were the three biggest reasons why smart people go broke. I'm certainly not saying everyone should use margin and leverage in investing. But I'm just pointing out that I think actually understanding that the biggest reason people fail in investing and for that matter in business isn't necessarily about knowledge and so on. It's actually about temperament. If you can have a really good temperament, even if your knowledge is 8 out of 10, you will easily be someone who has a PhD in investing, but their temperament is like 4 out of 10. Because at the end of the day, you never really know how people are going to react to crisis in business or investing until that event actually happens, right? So I would say one of the biggest takeaways about this is focus on behavior, controlling emotions as much as you can, and always consider how did you behave in the past when something bad happened. So, for example, if you're now in your 50s and you panic sold during the 2008 financial crisis, that's probably a pretty good sign that you're not a high risk investor. And that's probably a pretty good sign that you should keep your stock market allocations down to a sensible percentage, because if it happens again, you'll probably panic again, more than likely. Not for sure, but more than likely. So I would actually look at the behavioral aspect as well, the psychology behind money. And there's a lot of good books about that, money and psychology, and how people behave in different situations. And that's one of the most when it comes to investing in business, the people don't factor in.
Yeah, it's one of those subjects that's easier said than done, isn't it? Where you won't know how you react until you get to that situation. I know that from speaking to people, both on the podcast and off air, given everything that was happening in April, there was a few people that were looking at what was going on and looked at, I think it was the S&P 500 when it was about 48, 4,900. And again, what I would consider very intelligent people, even they kept away from it because they weren't sure at the time. It could have got a lot worse. It didn't. And funnily enough, I think it was about 48.35 was the bottom back in April. And obviously, look where it is now, just under 6,300. But even very smart people, other contrarian people, looked at that and even they weren't sure at the time as well. So even they sat on the sidelines. That note aside, Adam, I think it's been a very open and enjoyable conversation. I think there's a lot of information there that people can take away from. But I appreciate that, as we said at the start, you help a lot of clients in a lot of countries, do a lot of things. So if people want to connect with yourself, connect with your team, how can people find you and get in touch?
Yeah, so the best way is through my website, which is adamfayed.com. You can also email me on hello@adamfayed.com. You can see my WhatsApp on my website as well. If you can tell me that you've came from this podcast, that would be great. But if not, I'll still speak to you. Don't worry about it. So no, look forward to hearing from you.
Perfect. As usual, I'll put those links and contact details in the post that comes with this podcast and video as well. Adam, thank you very much for your time. It's really enjoyable. A lot of actions there for people to action themselves, and look forward to hopefully catching up in 2026.
Well, pleasure, and thanks for having me on again.